Okay, let's take some more questions. Ipshita Moitra has this question. What are the new tax rules on ESOPs? Is it applicable to all startups or only those registered with the government? That's an interesting question. We will come back to the new tax regime, but this is another important point, especially for a lot of people working out there with startups. And you know, Startup India is a reality. There are a lot of people today who come out of college and they want to work for startups. Some are founding it on their own. What she said about the ESOP rules, is it applicable to all startups? And can you tell us what the new rules are and how it impacts people?
Yes. Firstly, it's not applicable to any and every startup.
Okay.
It's only applicable to startups which are registered under Section 80 IAC of the Income Tax Act.
Okay.
What that means is that these startups need to have a certificate from a government body. It's an interministerial board of certification. So they need to approach that board. You can apply for this certificate online. And you must meet certain criteria. One of the criteria is that you should have been incorporated before 2016.
Okay.
And that hasn't been changed yet,
Oh.
right? So, and there are a bunch of other conditions that you need to satisfy to be able to take benefit of this particular change in the ESOP taxation. Okay. So that's the applicability. But you know, the government has released certain numbers where they've said about 27,000 startups are registered with them. And that's a huge number to look at. So definitely this is a tax benefit that they're going to pass on to a lot of startups. But now coming to the actual amendment in the Act on ESOP taxation. Frankly, the only thing that they've done is a deferment, right? So typically if you have ESOPs, they vest you know, for you, or you can exercise them after a certain period of time. Say for example, you join a startup and you are allowed to exercise 20% of your ESOPs after a year, right? So what really happens is the moment you say yes to that and you exercise, whatever is the fair market value as on that date, less the exercise price is what you end up paying in taxes. But there's no real cash flow for you, right? You haven't really earned an income. You've just received certain shares from your employer, but and you end up paying taxes, right? So the only thing that they've done is that they've deferred this tax event. They've said that you pay this kind of tax only at the end of 5 years, or if you decide to leave the company, you pay this taxes then. So that's the only thing. It's only a deferment. It's not like those taxes, you know, they no longer apply. They've been deferred.
But deferred to a point where I could receive some money by that time, and that will help me pay the tax.
Well, not exactly, you know, unless you really sell, you know, these shares, if you get listed, which is actually pretty rare, or if you're able to exit, you know, privately, it's only then that you may receive something on those ESOPs. But if you decide to quit, then the whole idea of actually paying money for shares that, you know, you've decided to quit that company, and then it doesn't make much sense. The other thing is, you know, on ESOP taxation is the whole stuff around its implementation. Because you know, in your salary, or your employer will actually report in that particular financial year when you exercise that option. So they will report it in your Form 16, but they will not deduct any TDS, right? The TDS will be deducted at the end of 5 years or whenever you decide to exit. So it will appear as a sort of a tax payable from your side. And I'm not really sure how the income tax department is going to manage, you know, a tax payable appearing against a PAN. So they'll have to do certain system changes and stuff like that. So let's see how that works out.